G'day guys, this is Tony Mascali, your Elliott Wave technician, presenting video number 2 in a series of videos covering mastering of the Elliott Wave theory. In this video I'm going to go over and break down these waves and explain to you how I came to this count and how I applied the rules that we went through in the first video. Just one thing that before we dive straight in, is there was something I wanted to put into the first video that I missed. For those of you who need clarification about the rules of Elliott Wave and exactly what the theory is, I suggest you watch the first video. And even if you've been practicing Elliott Wave theory for a long time, you may want to watch it, because I practiced the original wave theory as intended by the inventor, and it has been modified by a lot of people over time. Anyway, what Ralph Elliott had to say about volume. In advance, the volume of wave 5 does not exceed the volume of wave 3. Occasionally it is less. So long as volume increases, another advance is due until a new high registers without an increase in volume. See figure 95. Okay, he also says that, note also that the volume of wave 2 is less than the volume of wave 1. It is a favourable indication. Okay, well, the reason that he made that last statement is that elsewhere in his book he says that the impulse waves 1, 3 and 5, and being A and C in a ABC pattern, they're the impulse waves, they tend to have higher volume than the corrective waves. So that's another one of his traits, and I've found that to be the case, and particularly in bear markets. So what he's saying there is that the volume in wave 5, you usually get a volume towards the peak of wave 5, but it should register less than the peak of the volume at wave 3, as it shows in this diagram. It's not by a lot, but it is less. And what he says there is, if by chance at the peak of wave 5, or at least where you think you've got the peak of wave 5, if the volume at the peak of wave 5 exceeds the volume registered through the formation of wave 3, then you don't have the high. You'll have another high to come. Maybe the wave 5's extending. Okay, so look, that'll make more sense because I'll cover that in a later series of the video. Okay, and let's go back to the chart. Now, in this video, I'm going to cover how I get from the 1932 low to the 2020 high. And I'm counting that as Supercycle Wave 3 of the first grand supercycle. My data goes back to 1915, and I can only see the tail end of the previous bull market. However, in the good book, The Major Works of Elliott, Ralph Elliott was quoted as saying that a bull market that began from 1857 up to this high was wave 1 of a grand supercycle, and that the correction down to the 1932 low was wave 2 of a grand supercycle. If the inventor of the theory states that, then that's good enough for me. I don't need to get the data and check his phone account, and I practice his rules, so that's it. I know other people have labelled that wave 4, but they've looked at some. There was a stock trading in Europe, some South Sea stock. It was a South Sea company. It was a private company. A lot of wealthy investors got involved in it. There was fraud involved. It was a bit of a pump and dump, and people lost a lot of money. And you could argue, some people argue that that bubble was the 2-wave and this is the 4-wave. But I don't even think the Dow was trading back in the 1700s. So to me, how can you have a wave before the market even came into existence. I don't subscribe to it. Anyway, it's up to you whether you want to subscribe to, believe what Ralph Elliott said in his book, and run with that. Okay. What this is a monthly bar chart of the Dow Jones Industrial Average going back from 1915 right up to the current. This is presented by TradingView. I'm not a subscriber to TradingView. I'm subscribed to another package called MultiCharts. MultiCharts has an easy language that allows for easy programming of rules for automated trading systems, and I like to dabble in automated trading systems. However, this is a very friendly package. It's a great package to learn how to chart. It's free. I think your data's 10 minutes delayed if you don't pay, and you get a few ads popping up here and there. But it's a very friendly package. Unfortunately, it facilitates for what I use for long-term counts, or what I prefer to use, which is a semi-log scale. When I say semi-log scales, what is semi-log scale? Semi-log scale means that the price scale is logged, but the time scale is not. That's why it's semi-log. If it was a full log scale, then you'd be logging the time and the price. The X and the Y axis would have to be in log. No one logs time. So the reason that we log price is that it means that any price movement anywhere on this chart, the same size movement will be the same size percentage anywhere on the chart. If I was to show you this chart for a brief second and what it would look like on a regular scale, or an arithmetic scale, which is what 90% of charts look at, you can't make hide nor hair out of it. It's just garbage. This early stuff just looks like a flat line. So look at the 2932 crash, a 90% devaluation in stocks. It looks like nothing. You can't even see it. And that's because the market went from 400 down to 40. 360 points. That's its average daily range nowadays. Just over, that's about 1.5% of the market. So an arithmetic scale doesn't take into account the increase in volatility over time. And so you're putting the scale in percentage when you do it in logarithmic, and that normalizes it over the long term, so that the volatility is consistent all the way through the chart. And if you're going to try and apply long-term wave counts, don't even waste your time looking at arithmetic scales. Okay, enough about scales, let's get into this now. So, the way that I approach Elliott Wave theory is probably different to how most people approach it. What I do is I look at the wave counts from the top down, not from the bottom up. To clarify what that means is that if I, for instance, started with a 5-minute chart and I counted out a 5-wave pattern on a 5-minute chart, and I label that as wave 1 of a larger 5-wave move, and then I went to a half-hourly chart and label that out, and then an hourly chart, a 2-hourly chart, a 4-hourly chart, a daily chart, a weekly chart, and I built up my waves from the bottom up. If you do that, you're likely to get into trouble. You're going to get lost, and you're going to give up, and you're going to say this theory doesn't work. And the reason that you'll come to that conclusion is that the Elliott Wave theory was intended as a mass psychology theory. That is, the more people that participate in the wave, the more likely it will conform to the theory. So the tiny little waves that you see on a 5-minute chart don't have mass psychology in them. You haven't got a great percentage of investor participation. Therefore, you can't expect those waves to be as well formed and easily identified as the major waves. Hence, Elliott Wave is more useful for longer term forecasting than for short term forecasting. And the problem is, everyone wants to use it for day trading and for scalping. Well, you're going to find it very difficult to expect the wave counts to work on a 1-minute chart, on a tick chart for a scalper. So that's why I do it this way. And to give you as an example of how I derived at this wave count, By the way, I didn't come up with this count just now. I came up with this count in 2013. It was about here in the market. And the market was knocking on the old 2007 high. I published a report for a small client following, and in that report I came up with this wave count in exactly the same manner as I'm going to explain to you now. And in that report I was forecasting the Dow to peak somewhere between 25 and 36,000, something like that, and I think the preferred target was 28,800. The market peak just shy of 30,000. And I also came up with what I'm expecting for the next super cycle, and I'll go into that in the next video. But this is the way that in 2013 I came up with this count. I looked back through the entire bull market from the 1932 low, and I asked myself, what are the largest corrections that I see, the largest downward corrections? And I can see that one, and that one. So now what I do is I try and apply Elliott's rules to see which of these corrections fit together best, identifying, grouping together the wave 2s and the wave 4s. So using the channeling technique, I test these two, this correction and this correction. If I draw a line connecting that high to this high and go parallel, bingo, I hit the bottom. So that's a good fit. Given that that's a good fit, I then look at, do I have alternation? If that's a good fit as a base, I'll start with that count. I'll label that as wave 1. So this is a super cycle. We're in a super cycle. I'm labeling that wave 1 of a cycle, 2 of a cycle, 3 of a cycle, 4 of a cycle. And see if that conforms to the rules and fits as a good count. Okay, so do I have alternation between 2 and 4? Well, what's wave 2? A, B, C. The B falls shorter, well short of the high. That's a zigzag pattern. That's a zigzag. What's this correction here? It's a classic expanding triangle. A, B, C, D, E. All breaking down in 3-wave subdivisions. There's no 5 waves in the whole thing. There's no impulsiveness in the whole thing. So that conforms to the rule of alternation. Is the wave 3 the smallest wave? Well, I can see it's way bigger than wave 1, so there's not an issue. Does the wave 4 overlap the top of 1? No, it holds well up. So on face value, that ticks all the boxes. But then what you have to do is go down and break it down to the next degree down. So I started with the cycle degrees. Now I go down to the primary degrees, which are the circles, the green circles. So the purple Roman numeral capitals, they're my cycle degrees. The 5's up there. And the primary waves within the cycles, if I label that as 1, 2, 3, 4, and I'm looking for 5, do they conform? Well, let's start with the first cycle, wave 1, which was the 1932 to 1937 bull market. That bull market, by the way, I showed you in one of the chart examples in Ralph Elliott's book, and for the purpose of rule of alternation. And I made the comment that it alternates because, and it was counted the same way in the book. So the rule of alternation, this wave 2 is a zigzag, this one makes a double top, it's a flat. That alternates. Does the wave 4 breach the top of wave 1? No. Is the wave 3 the smallest wave? No, it's bigger than wave 1. It's not the biggest, but it's allowed to be the second biggest. does the 2-4 channel with the 1-3, and that's something that I do. I look for that in the big wave counts, and it is an amazing. If that's all you take away from these classes, then it'll be worth your while, because I can see there that I just missed that high slightly. I'll make that as accurate as I can, and just put that, because I wasn't zoomed in when I drew that. Now, unfortunately, I can't drag that to keep it parallel, because it's not designed for semi-log scale. It's going to keep that parallel in arithmetic terms, which is no use to me, not on long-term stuff, because I'm looking for these percentages to be equal and parallel, not interested in the arithmetic moves in the Dow. So, and there's a lot said about this in Ralph Elliott's work. He was a big believer in semi-log chart scales. Anyway, I have to do it by eye of where it's most parallel. And what do you get? Picks the bottom of the market. So if you had that, and that high, and the market was heading down, you wouldn't be buying it here. You'd be buying it here. You could buy it at the same level here in October 33, but why would you buy it in October 33 when you can buy it in July 34 and have an immediate launch? If you're an options trader and you bought your call options here, they would have expired worthless. If you bought them here, you might have made some money. So that gives you the timing of when the wave 5 is going to launch and the level. Beautiful. Also, that low is against this support of these two lows. It looks like a 0.382 retracement. If you start analysing it, everything's going to fit together. So I'm not going to go into that degree here, because I'll never get through this video. But you can do that in your own time and check all those things, and you'll find that the Dow has Fibonacci all over it. In fact, the pattern of Elliott Wave theory is the 5 waves up and the 3 waves down is 5 up, 3 down, 8 waves. They're all Fibonacci numbers. And if you expand out the 5-3, 5-3, 5 and the 5-3, 5, you're getting 21 waves up and 13 waves down, and if you keep doing that, you're going to hit all the Fibonacci number series. This whole Elliott Wave theory is based on Fibonacci. That's why Fibonacci retracements go with Elliott Wave. And there's Fibonacci relationships between the waves. For example, it's common that the wave 3 will be 1.618 times the wave 1. It's common that wave 5 is 0.618 of waves 1 through 3. It's a very common relationship. It's not the case here. I can see it's bigger than 0.618 of this entire move. It's more equal. If you like Fibonacci, Elliott Wave and Fibonacci go hand in hand. Okay, so we're happy that the first cycle wave conforms. It's got rule of alternation, it parallels, it conforms to rule of overlap. Wave 3 is not the smallest. It ticks all the boxes. Let's look at the next set of primaries, and that is the third wave's an extension in the cycle wave. It went from 1942 to 1966, so about 24 years. Extensions, as I said, most commonly occur in the third. They don't have to occur in the third, they can occur in the wave 1 or the 5. However, extensions rarely occur in more than one of the 3 impulse moves of that degree. So because we have an extension in the third cycle wave, it means we're not likely to have an extension in the 5th cycle wave. And we didn't have one in the first. That was the first. It was only a 5-year move, right? 32 to 37. Okay. So, with this, going from there to there, what are the 2 largest corrections? Right? This area here and this area here. Okay, so, and this helps you to identify the waves don't always peak on the exact peaks and troughs because of an irregular B wave flat. But when you do the paralleling, it helps you to interpret. If I connect this high labelled 1 with this high labelled 3, green circle, then this line here, drawn parallel, placed at the bottom of wave 2, parallel, what do you know? It picks the next major low. Okay, so that's a top contender if that alternates for those two corrections to go together. Okay, what sort of a correction is that? What does the B wave do? Falls well short of the beginning of A. The C wave bottoms with the A. A lot of people would say that's a flat correction, but it's not a flat correction. Not if you follow Ralph Elliott's rules. It's all determined by the position of the B wave. That's a zigzag. What's this one here? A, B, C. Because our channel is from there to here. That's an irregular flat. We covered that as an example in the book. 3, 3, 5. Irregular flat. Okay, what do we got? We've got a zigzag alternating with a flat. We've got a perfect paralleling between the top of wave 1 and 3 and 2 and 4 on a primary wave degree. Perfect. Wave 3 is the largest wave. Great. Wave 4, does it overlap wave 1? Does 4 green circle go under wave 1 green circle? No. It's great. Alright, ticks all the boxes. So that's looking great. Alright, so let's go to the last cycle and look at the primaries. I came up with this in 2013, so let's just stop it at 2013. And how did I come up with that in 2013? Well, in 2013, what were the largest corrections in this cycle, beginning from the December 1974 low? And they were this one, this one, this one, and this one. Anything else is much smaller. What I do now is I try and find which one of these fits the parallel channel the best with the next three. This one, and this one. Well, that one, that's not going to parallel, not even close. I'm not going to draw it to show you, but it's going to look like it's going to converge in to that. So it's not going to work. The next one, which is that 3 to 4 down move here, this one here, it's close, but it's too big for that. The best fit is this one. When we draw it, the top of 1 to the top of 3, and go parallel with this one, just reposition that again. By the way, if you want to check if that's parallel in this package, because you have to judge it by eye, you can't move it there, what you do is you draw a vertical line at one end of it in trading view, and you set the properties in that line to display the size of the movement. And in the brackets there, it gives you the number of points and it gives you the percentage. Well, we're in a percentage scale, so we're interested in percentage. That's 55.38%. This is a check to see how parallel I am. And we go to the other end of the channel, and if we've got the same percentage, we're parallel. Okay, we're a bit bigger at 59, so we'll take it back to 55.38, 55.83. You're not going to be able to draw any better than that. Plus, you've got these thickness of lines. You can't get exact, but actually, parallel is actually there. Oh, we're a bit high. Parallel's about the bottom of that line, which is there. All right. Okay, that's not bad, and I'm slightly chopping that low, so it's actually pretty close to the bottom. It breached it by a tiny amount, which is not a bad target. Pretty good method. Given that it had to break that major support to hit this line, drag it down a little bit, and then adjust that accordingly, because that's now, I'll pull that away from that bottom there, so that's about where it is. Given that it had to break that to hit it, a lot of people would have panicked and thought, oh, the world's going to fall off, the Dow's just broken this multi-year low. But the channel's going to go, no, the real support's down here, not a problem. That there, now we've got to check rule of alternation. What sort of a correction's that? It's got a double top, A, B, C. It's got a double top and a double bottom. The A and C bottom together, and the B peaks with the top of the A, at the start of the A. That's as flat as you can get, as flat as a pancake. That's a flat correction. This is the GFC that we're comparing it to, which is the 3 circles to the 4 circle. So we're comparing the down wave for the 2 green circle and the down wave for the 4 green circle. They're the 2 primary waves. And that there is a simple zigzag. Well, I might not have mentioned this in the first video, that zigzags are also usually simple corrections. They happen quickly, they're simple, and flats are more complex and harder to count. See how messy this thing got? It just sprawled itself and chopped all over the place. Well, that's typical of flat corrections. They're often called complex corrections, and these are called simple corrections. And that's another way that waves alternate. But simple and complex was more developed by Bob Prechter and Frost, and not so much used by, that term wasn't used much by, I don't think Ralph Elliott used it, but I have read all the books, so I might be slightly tainted by that, but it doesn't matter. That is a fair observation, someone who's been doing this for a long time. Zigzags are normally simple type corrections, and flats are usually very complex, because that alternates. And in the next video, I'll be breaking down that wave on a shorter term chart and show you how it breaks down. And I'll show you it's a zigzag. But just take my word for it at the moment. It's a single top, there's no double top in it. And then that leaves, because that's an extended wave, we're just going to check the intermediate waves within the third wave while we're here to see if it conforms. I did this in lighter lines, otherwise it just gets too messy. And I've drawn these parallel. I've connected intermediate 1, which is the red brackets 1, with intermediate 3, which is the red brackets 3, and gone parallel to intermediate 2 low. And this thing's getting in the road. Here, righto. And what you'll see is that the market goes a bit past it, but it's not bad. But we're now getting down to intermediate degree. So see what I mean? Primary degree, they're perfect. You go down to intermediate, they're about 80%. They're not as good. Start going down to minor and minuet, it's not going to be as good. It's going to get worse. And that's why Elliott Wave theory is at its strength in the big waves. So don't worry about too much about bogged down in the small waves. Get the big waves right. Keep it simple, and you won't get in trouble. Okay. That's within about 20%. It's pretty good. That's the simple zigzag of the 87 crash, the 2 wave, the 4 wave, which was the 2000.com 2002 bear market. That was a complex, had double, triple tops in it. Definitely not a zigzag. That's a flat type correction. Right, rule of alternation. Is wave 3 the smallest wave? No, it's the biggest. 3 brackets, the biggest out of those 5. That's good. Does wave 4 breach the top of wave 1? No, all good. Real overlap. All boxes ticked. So what I've just done now is I've shown you that count using that as a cycle 1, 2, 3, 4, and assuming that the rest of this is tracing out of cycle 5. Right down to the intermediate degree. I don't know if we check the intermediate degree of this extension. I don't think we did, so we'll check it now. So I'm talking about wave 2 low, primary. This is within the 3rd cycle. The 3rd primary traced out an extension, just like the 3rd primary did within the 5th cycle. And in that primary, I've broken down the intermediates. And if we look at those intermediates, I'll blow it up. I'm checking whether that high connected to that high, 1 and 3, red bracket, parallels with the low of 2, red bracket, to 4, red bracket. And I've drawn those 2 lines in as parallel as I can. I did them thin to not clutter up the chart too much because they're more minor waves. And that high to that high, parallel from here. It's a pretty good job. It's within about 5% or 10% of picking the lower wave 4. Do we have alternation? Yeah, I think we do. You have to look at it. This one here is an irregular B wave, which is an irregular flat. So we just go put that back there. Right. Okay, that's an irregular B wave flat correction. This one here I don't know if I can get that to start. I'll have to start here because it's going to grab something else. Okay, I'll fix it up in a sec. Okay, so I'll just show you what's going on here. That was covered in the book as an expanding triangle. But you can have it with flat top or expanding tops, that doesn't matter. That's called an ascending asymmetrical triangle. It's got a triple top and the bottoms expand. These are all 3 wave subdivisions, and it's certainly very complex. So that triangulates in a 4 position. That's an irregular flat. We have alternation. I've just broken down every primary wave within those cycles. They all confirm, they all channel perfectly. I haven't checked the intermediates within the extended thirds within those cycles, and they channel near enough to good. And the counts ticked all the boxes. I'm sure you can find other counts, other ways you could count from here to here, but you won't find any counts from here to here that conform to those exact rules more closely. That's why it's my preferred count. you'll see that my channeling technique gives me very few options. I just pick the ones that channel the best, and that makes Elliott Wave so simple. You haven't got 10 different alternative counts. Okay. This video was about showing you how I count from the 1932 low to the recent high in February 2020. In the next video, I will break down the GFC, and I'll break down the bull market, the last bull market, from the March 2009 GFC low up to the February 2020 high, to see how well that conforms to a 5-wave count. And I'll also examine the volume patterns to see if the volumes fit these counts. Okay, see you in the next video. Bye.